Hi, welcome to Riverside Angel Summit. Today we're going to be talking about cap tables or capitalization tables and term sheets for entrepreneurs from venture capitalists or angel investors. My name is Scott Brovsky. I'm with UC Riverside. We run a program called Epic SBDC, where we help startup founders scale, grow, and raise capital for their startups. My partner in crime is Martin Kleckner, who's also the co-founder of Riverside Angel Summit along with me. And we have an amazing panel here, which I will get to right now so they can do a quick intro, and then we'll get into the actual content. So let me get my mouse working here. There we go. So Sean, you want to start out with a quick intro?
Sure. Hi, my name is Sean Varner. I'm the managing partner of Varner & Brandt. It's a local business law firm in Riverside and San Bernardino counties. And I specialize in all forms of corporations, from startup to Fortune 500 companies, and look forward to speaking with you all.
And you also want to talk a little bit about the vehicle you put together for Riverside Angel Summit called Citrus Seeds, the SPV?
Oh, yeah, we put together a company called Citrus Seeds, which is an investor pool for investing in an angel investment network that Scott's involved in, where there's going to be pitch competition, and the winner of that pitch competition will receive investment from Citrus Seeds.
There you go. And that's Riverside Angel Summit. So I know not all of the startups that are joining today, or I think most of them actually have applied to Riverside Angel Summit, but I just want to make sure we got that in there. So thanks to Sean and his team for all their help with Riverside Angel Summit and in putting together the SPV Citrus Seeds. So Steven's next on my screen. You want to go, Steven?
Sure, Scott. So hi, everybody. My name's Steven Dunst. I'm an attorney in Cooley's Santa Monica office. So we're located right at the 3rd Street Promenade. I'm born and raised in LA, ties to Southern California, and have been here my whole life, except for undergrad at Berkeley and then law school at Harvard. I've spent 3 years working with entertainment and media companies before joining Cooley's LA office about 8 years ago at this point, to work with early stage companies. So virtually my whole practice is serving as outside general counsel to startups of all shapes and sizes, seed stage all the way through unicorns, and excited to be here.
All right, cool. Thanks. Zach?
Yeah, absolutely. And thanks so much. My name is Zach Myers. I am a corporate and securities partner at Wilson Sonsini, where I specialize in helping startup companies that are in the technology and life sciences space grow, raise venture capital, and then ultimately either go public or get sold. I am in the San Diego office, but I split my time with LA and the Bay Area as well, and work primarily on the company side, just only helping companies that are looking to raise that venture capital needed to grow and scale their businesses.
All right, great. And you're going to actually get us started. Let me just go to the next slide here. So we're going to do a cap table discussion now. Zach's going to present some slides. As I said earlier, for those of you that just joined, you can put any questions you have in Q&A if it's relevant to what we're talking about while our attorney group here is presenting, then we'll ask it. If not, we'll hold that question to the end. So if we skip over your question, don't worry, we're going to get to it, just maybe not as they're presenting. So we're going to kick off here with a cap table discussion. We'll go to Zach's first slide. I guess we already know this since you just introed yourself, so I'll go to the next.
Go ahead and skip that.
Yeah.
So just 2 minutes on just a quick intro of who I am. So, mentioned that work with a number of early stage companies looking to raise venture capital. We look at our practices generally just in terms of 3 spheres or 3 circles. And the one that I'm primarily in is the early stage entrepreneur venture capital startup. Usually from there, you raise money, you grow, and then ultimately either you go public or you get sold at that early stage. And we kind of refer to that as our second circle practice. And then we also work with large global multi-billion-dollar companies like Google and Twitter and Tesla, that we refer to as our third circle. But we like to scale with clients from day one all the way up. And just go ahead and skip to the next slide there. So as I mentioned, my practice and my firm in general is just literally technology and life sciences. And some of the names of companies that we've worked with all the way from day one to going public, and in some cases getting sold, are on the technology side, companies like Google and Tesla and Twitter. And in life sciences, Illumina and Juno, and clean tech, Tesla and Solar City, just some examples. But the point of this is not that every client has to be that big literally on day one. all of these were very, very small companies that were in your shoes, and they all grew in scale and became incredible, incredible businesses. And that's what we like to help entrepreneurs do. So just go ahead and skip. We also, I represent companies, but I understand that it's really, really important to help companies grow and scale. And part of that process is helping connect companies with providers of capital. And we work with a number of great venture capital firms. Many of you know these names, but they like to invest in clients of the firm, and they also like to invest in companies that just have groundbreaking technology. We've worked with many of these folks kind of along the way and have good relationships with them, and so do many of the other people on the panel as well. Go ahead. In Southern California, it really is the third largest venture ecosystem in the country. We have some of the best universities in the country that are out there. They're working with technology that's absolutely incredible. It's being developed at these universities. It's being potentially spun out. You've got world-class professors. It really, really is an ecosystem that many people, that Scott and Martin have been part of, that have really built this ecosystem that is driving the future of innovation and growth. And we're frankly proud to be part of it. There are a lot of venture capital dollars that are going into it, and we think it's very, very exciting. So with that, I'll just kick it off and talk a little bit about cap tables and some of the very, very early discussions that Sean, Stephen, and I have with founders when they come into an office for the first time. And really what the founders are trying to do is figure out what a cap table should look like, what the ownership of a business should look like, and how is that going to play into financing discussions later on. And all of that is really going to depend on kind of the value that each of the founders brings to the business, how much they're going to contribute to the business on a go-forward basis. And it's really important to have those kind of discussions early on. Be frank with your co-founders, and you don't want to go into a relationship. And it really is a relationship at the beginning when you're forming a company with somebody where one person is going to do all of the work and they're getting 40% of the stock, and somebody else who's going to contribute something very, very minor and have no ongoing role. So that's going to be problematic, and we'll talk about some of the reasons why, but you need to have these discussions early on. You really just need to make sure you're allocating capital based on those expectations for what the founders are providing, what they're going to bring, and what they plan to bring in the future. Because you're going to have to defend this cap table by the time we actually go to raise money later on. And VCs, if they're investing in a business and see that somebody's got 90% of the company and aren't providing any services, are going to have a problem with that. So just to put that on the table is the very, very high level overview. Let's go ahead to the next slide. So, like I mentioned, when you're working with other co-founders, other service providers, just figuring out the value of the services that they're going to provide, how much they're worth, and having those discussions very, very early on is absolutely critical. You're also going to be thinking about things like option pools and putting an option pool in place to compensate service providers. Because one of the reasons why is, you can't, as a startup company, pay the salaries that a Google or somebody else can pay to their employees. So how do you incentivize people to stay? How do you keep them there? How do you get them excited about the company? And one of the ways that you do that is you provide some equity early on. Knowing that you're going to have to pay some salary, but really the bulk of their return is going to come from their equity in the business. So you set aside things like option plans, and we typically see 10 to 20% reserves for equity incentive plans early on. But a lot of that is going to depend on what your option budget is, who the key hires are that you're going to need, and you're going to have to see kind of how that's going to play into your financing, because too big of an option plan can have some negative impacts in a financing that Stephen may chat about later in his discussion. Just other things, options and equity, just very, very early on. Making mistakes in this area can be expensive to clean up and fix. So you really want to make sure you're working with kind of competent counsel to get this right. Delaware, and most of our companies are formed in Delaware, is very, very technical with respect to securities issuances and stock issuances and option issuances. And it's fairly easy to kind of get that stuff right early on and fairly cost effective. If you make mistakes there, you're missing things, you don't get board approvals, you're looking at a very lengthy and costly cleanup by the time you get to a Series A or Series C financing. So just make sure you're working with somebody that knows what they're doing, that can kind of help get that right early on in the process. And go ahead and skip to the next slide. So, one of the other things that we absolutely stress is that when you're working with service providers, everyone enters into the company with the idea that they're going to be providing services on a go-forward basis. And that's great, but it's really, really important to tie kind of their service to the company to vesting. Because what you can't have by the time you get to a financing is a situation where, Martin and I went into business together and I got 70% of the stock and he got 30% of the stock. And I decide I'm just going to leave and take my stock with me, and he's going to be running the business on a go-forward basis. And Martin has no ability to get that stock back from me, right? He is no longer incentivized to provide services to the company on a go-forward basis because he's got a small fraction of the equity. And any investor coming in and looking at that is gonna puke all over it and say, my goodness, we've got a service provider that's got 70% of the stock and isn't doing anything on a go-forward basis. So making sure employees and consultants, frankly, are vesting in their stock, effectively earning their stock kind of over time. And the typical vesting that we see is 4-year vesting with a 1-year cliff. And what that effectively means is that if you leave in the first year, you don't get anything. After the first year, you vest in 25% of your stock, and then you vest kind of monthly after that. And there are different forms of acceleration that may go along with that. Early stage companies, you don't see a lot of severance just because there isn't a lot of cash to pay that out. But you do see things like, a lot of times you see what's known as double trigger acceleration, which means effectively that there are 2 triggers for when you'd accelerate. One is, the company getting sold or a change of control transaction. And the other is you being terminated as a service provider. So in that event, you would fully accelerate and kind of get your stock. And you sometimes see more complicated vesting structures with milestone vesting. Other options sometimes you see for service providers, usually very, very high level employees of the company. Sometimes they'll ask for what are known as early exercise options, where they actually write a check early on. This used to be very, very popular around the year 2000 and has since kind of died down a little bit in popularity, but you do sometimes see it with very, very sophisticated consultants or advisors that are coming in a very, very senior role, and sometimes executives as well, who have the ability to write a check early on and kind of contribute to the capital of the company.
So Zach, let me just interrupt you with 2 things. First, that's so we work with a lot of first-time founders. Our region doesn't have a lot of serial entrepreneurs at this point, and so I can't tell you how many startups have come to us with fully vested, all the founders fully vested, and it's a challenge, because what happens is exactly what you just said, where one of the co-founders decides to leave and they already own 25 or more percent of the company, and then it's a mess. So thanks for bringing that up. I always hammer on that point for new founders, but it's of course great to hear it from an actual attorney and not for me. And the second thing is a question from one of our founders. Anand asks, what about if you've been at this for 3 years on a 4-year vesting schedule and are now looking to raise from VCs? Will we need to restart the vesting?
It's going to be a discussion. So the VCs are going to want to make sure the founders are really tied to the business. They're putting in their capital in the business, and they want to make sure you can't walk with your stock the next day. I would, if you were company side, you would try to fight that as much as possible as part of that discussion, and say, look, I've been at the business for 3 years. I have worked really, really hard, and I have earned that stock over time. And you've still got some hook in me where I've got another year of providing service. VC investors will take a different stance and say, look, I want to make sure you're incentivized to stay with the business as long as possible. And their starting point may be to restart vesting there. So, when your company side, you push against that. And on the VC side, they typically advocate for it. And it's really going to depend on, who the founder is. If the founder has really been at it for that period of time, committed to that period of time, I think you've got a good argument. You may not get credit for the full 3 years, but you may get 2, and you can certainly push for the full 3. But it's a really, really good question, and it's something that's absolutely going to come up as part of those discussions. Because again, when investors are putting money in the business, they're investing in that management team, they're investing in those founders, and they've got to know that those founders just can't walk away the next day with their money locked in the company with no hook to keep those founders there. Another thing I'll add is just that, and we do this a lot with the startups we mentor, is that a lot of advisors
want a 1 year, depending on how strong they are and how much they're going to move your business forward. They may ask for a 1 year deal with no cliff and monthly vesting. And obviously that's something you'd have to negotiate and decide if they're going to bring enough value to your business to do a 1 year deal. And that's something, again, that your attorney would help you decide if that's a good idea or not. And Ed has a question. I'm not sure I'm not exactly understand what he's asking. So Ed, we may need you to put a clarification there in the Q&A, but you're asking, how do you handle relevant service providers who cannot provide equity into the company? I guess he's asking, maybe he means aren't providing any relative consultants. I'm still not. You mean relative consultants as in like someone who actually is related to you? Is that? Anyway, I think, there is some confusion about having consultants and or advisors. And also Steven and Sean, you can also, of course, chime in and answer any of these as well as we go through these. But I think Ed, maybe you can type in another update to that question. I'm not understanding it. Zachary, are you getting it? I'm not exactly sure what he's asking.
Not exactly, but just to take a minute to reiterate your point there, Scott. It is very, very typical when you see certain types of consultants and advisors that are not going to be there for the full 4 years. Maybe they're on your advisory board. Maybe they're providing a year's worth of services for their vesting schedule to be on a monthly basis and to really tie to the period that they're providing service. So, to your point, the 4 year vesting is very, very common for employees of the company who are going to be there on a long-term basis. But there are times where you may need different types of service providers where they're just not going to be there for 4 years, where a different vesting schedule may be appropriate. But it's still important to make sure you're tying them to some schedule so that they can't just leave and take their stock. So there's an incentive to provide good quality services to the company. And I think we could probably skip ahead to the next slide.
Yeah, let's do that. We'll come back to you, Ed. Let's keep going.
Yep. So, just a couple things that I want to hit on here. We sometimes see, and this is a big mistake that we see among founders, where there's something written on a napkin that says, Martin has 25%, Scott has 50, and I have the remaining 25%. You really want to make sure that you've actually issued the stock, that you don't have these percentage arrangements and understandings. That just triggers all sorts of problems later on. Because what happens when you go out and raise additional money? What happens when you sell additional stock and issue additional equity? Or do those percentages change? How does that work? It just creates all sorts of problems. So make sure you kind of get the numbers up front. You issue the stock up front. When you're issuing stock that's subject to vesting, make sure you're working very, very closely with your attorney and your accountants and filing an 83B election, especially at the point where you're starting the company and you're issuing stock subject to vesting or subject to a risk of forfeiture. That's one of those things where you should discuss with your attorney, but the consequences of missing it are horrific. So just keep that in mind. And then again, work with your attorney to make sure you've got the proper paperwork, the proper documentations, the proper approvals for your board and everything else in place. And go ahead and skip there. So just one example, and then I'm sure some of the other co-panelists will have comments of different ones. But a company that's got two founders, Matt and Joe, working together, they decide that they want to have a 50-50 split. When you see this, there's a problem right there. Normally, if you've got a 50-50 split and you've got two co-founders who don't agree, both sitting on the board together, both have an equal percentage of the stock. If there's no one else in the company can't continue to go on. You're in court and you're in litigation, and there's really no way to kind of make that business go forward. So have the difficult discussions early on and make sure you don't have a 50-50 split. Somebody is going to need to be kind of controlling. They've got an additional service provider that they decide to bring in, who's going to be, chairman of the board, and he's going to get some equity. They bring in a new CEO, and all along they're having those kind of vesting discussions, the amount of equity that these people get. What are their, relative contributions to the business right now and in the future? What are they providing? And they're coming up with effectively a cap table and what the vesting is going to look like for those individuals. And again, it may be different. You can see here with the CEO, there's 4-year vesting. There's nothing up front. You've got an engineer who's coming in who's getting vesting over 48 months. And then you've got the original co-founders who've got the traditional kind of vesting that we see, or actually a little bit different. It's a quarter vested up front, probably because they've been providing some services to the company already, and then the remaining vesting over 3 years. And we'll just flip so that we can see kind of what a cap table just looks like And what
Before
we would-
before we do that, I just want to make sure that I think this slide answers Cal's question is, let's say the current founders contributed to R&D, but not so much to the business. Then a CEO is brought in and added to the team. Do you think it would be a good idea for the current founders to develop an initial cap table before they consider which CEO will be better for the company? So I guess the question is, should these let's just call them technical co-founders have a cap table built and figured out before they start talking about bringing in C-level business talent, I think is the question. And
absolutely. And if you've got a company up and running and you're building the business and you've got two people that are working in the business and that are exposed to risk, you're going to want to, issue stock to those individuals, and then you can use your authorized shares or options to issue a service provider on a go-forward basis. If it's happening all around at the exact same time, where you've got two founders with an idea, nothing has started yet, and you're bringing in the CEO at that time, then you'd agree on it up front. But if you're running an operating business, you've got to make sure you issue the stock to those original founders as early on in the process as possible.
Okay, cool, thanks. So this is a good example of what I would call a basic cap table. So I guess we can roll through this. If there are any questions, we get questions on cap table, this type of thing all the time from founders. So this is a good time to ask the questions if you have any on this. And then also, again, Stephen and Sean, also feel free to weigh in if you have any thoughts as Zach goes through this.
Yep. So, this is just a cap table that we would typically see. This wouldn't be unusual. It wouldn't shock a venture capitalist normally. I mean, assuming that you basically, Matt and Joe are really providing services, they're adding value, they're still working in the business. We typically see somewhere between 10 and 15 million shares authorized. It would be very unusual for us to see something that would have 1,000 shares authorized, 100. We never see anything like that, or at least in a company that's going out and getting venture capital funding. So this would be something that's typical, that would be within the realm of normal that we would see. Then you've got the option pool in place, and you've got certain options kind of being issued out of that. But I'll let the other panelists just comment on their perspective as well.
Yeah, no, I agree with what Zach's saying. I think it's useful what we try to counsel founders on is, so sometimes it's, you say you're 50-50 and okay, we each have 1 million shares. That's useful, but then it's hard to see, well, where's the company kind of going from here? And so I think it's a useful exercise both to do what Zach is counseling, to sort of see, all right, here's what you're going to grant right now and in the short term, but then also to sort of think through and either talk to founder friends or talk to your attorney and try to get benchmarks. But hey, like, until I get to that, let's assume you want to raise, a price equity round, like until you get to that point, what are you going to need to issue? And so that's a way to just sort of align everybody. So let's say you think, look, we're going to need to bring on a true CEO hire who's going to take 30% of the company, or which that's one very different scenario from, hey, we have our kind of exec team in place because we're 4 founders, but we're going to need to hire some engineers and bring on an advisory board. Maybe then you map out, okay, like let's sort of earmark, even if you don't have a formal equity incentive pool yet, let's kind of earmark, 15% of the company. And you think that's going to be enough to sort of get you going forward, just so everyone sort of has, yes, you need to issue shares in that percentages. And you also just want to make sure that even once they have shares, people are kind of aligned in the expectations of how dilution is probably going to work and sort of who else you're going to need to bring on.
You want to add anything, Sean?
Yeah, I was just going to make the same comment Stephen did. Is sometimes I see the option pool a little bit higher percentage, around 10% sometimes, and startup. I also, it's probably a little bit later stage, but something to think about from a as you're looking at the cap table is whether you're going to have a phantom share plan for lower level employees. We typically don't do that at a real early stage, but it's something that you consider at a more advanced stage.
Yeah, I think that brings up a good question that we get asked all the time. And what happens oftentimes is that, especially first-time founders, they don't really understand how competitive it is to bring on talent. And so let's just take the example of where the founders have carved out 10% as an options pool. Well, when they actually get a CTO who's actually going to agree to work with them. Let's say that CTO is taking 7% of the company. And then let's say they find when they thought it was going to be like 2%. And then they have a head of biz dev they have to bring in because they're technical folks and they're not really great at selling. And that head of biz dev wants 3%. So then I guess my point is like, a lot of times what we see happen, especially with first time founders, is that options pool is gone and they haven't even really started to build their company yet. So in that situation where they potentially haven't done enough, would you just counsel them to just make the options pool larger, which of course would come out of their founder shares? Or I mean, is there any kind of best practices you guys want to talk about there?
Yeah, absolutely. So, a couple things that come to mind there. So you can always increase the size of the pool. You can always go out and have the founders and the stockholders create a bigger pool. I would just make sure you're working with kind of competent advisors along the way, and you're not giving away grants and amounts that are just disproportional to kind of what these people are providing. And an example, I mean, everything that Scott said was in the realm of normal, but if you're getting an advisor who's going to be CTO, who's not, world-class and game-changing, who's asking for 30% of the company, that's probably going to be on the high scale, especially if, you've raised a little bit of money so far or going into it. So really sit down and, to Stephen's point, kind of map out what you think you're going to need to get to that financing event, everyone that you think you're going to need to bring in, and bounce that off of your advisors and just see if those amounts and those ranges are within kind of the realm of what's normal and what's typical for those positions that you need. If you need a bigger pool, you can obviously increase it. And if you're bringing on world-class talent, that's a little ahead of where the median is, that's fine. But make sure you're within the kind of normal bands for those positions.
Stephen, I think you want to add something?
Yeah, I mean, I think all of this in terms of how much you need to give up, it's a question of leverage and how badly you need the person and how badly they need you. And you're going to have a hell of a lot more leverage once you do raise that round. So it's a little bit of a chicken or an egg, needing to bring on the people you need to scale to where you're ready for venture money. But at the same time, I've had plenty of companies that want to bring someone on and they're demanding 15% of the company. And as a CTO or COO, and the company is like, hey, we're going to imminently go and raise $5 million. Well, until you've done it, until you have money in the bank, you're a company that hasn't really raised money and they're taking a massive risk on you. And the service providers have massively de-risked, their own job security once you've raised money. So sometimes if it's not an essential hire, you do have a lot more leverage once you have a little money in the bank. And that's when it's a lot easier, to Zach's point, to sort of look and see, okay, like for a series, even, pre-series A, but a company that's raised $5 million, it's pretty easy to pull up benchmarks of, you're bringing on a director of engineering, what's sort of reasonable before you've raised. And when you're kind of, 3 people in a business plan, it becomes really hard. And that's where I do see some companies in position where they've already kind of given up the farm, so to speak. And so you just need to be really, really careful and try to push. Sometimes the solution is try to push hires that you don't, absolutely need until the company is a little more mature and you have a little more leverage.
Yeah, that's a great point. Sean, we're going to add something?
Well, I think it goes back to Zach's initial point in the presentation about planning ahead. And obviously some of these things are industry specific, but one point I would add, which it probably seems obvious, but I've seen it way too many times, where founders negotiate an option pool or some shares for someone they think is key, and they grant non-dilutive shares, which is just that's devastating.
That's a great point. We sometimes see that as well. The only times where we actually see that, where it's customary, are very, very early stage on in university licenses. There's sometimes you're working with a Stanford, you're working with UCLA, a UC Riverside, and you're licensing critical technology. Sometimes there is that anti-dilutive component, but it only goes up to the first financing, up to the first dollar amount. It's got very, very strict parameters around it. But Sean's point is outstanding. I mean, if you do that and you grant something like that to a founder, co-founder, it's going to be a huge problem going into the financing. Nobody's going to invest until that term goes away. You're going to have to clean it up, and then you're speaking with that co-founder without a lot of leverage, because you're going into that financing event where there's a lot of money on the table.
Yeah, that's a great point. And we see that a lot too, by the way. Okay, should we go to the next slide?
Yep. So just some practical tips, and I know the other panelists have others here, but make sure you really have those difficult discussions up front. Make sure everybody's on vesting, that everybody at least understands and is comfortable with their allocation. It's never going to be, exactly perfect, but get it as close to perfect as possible. Because once you raise money, once the stock becomes worth significantly more, it is extremely difficult to change those cap tables around. So just keep that in mind. Other things to keep in mind, when you're doing preferred stock financings and you're raising Series C and Series A financing, I think you should anticipate that kind of 50% dilution. I mean, investors coming in are going to take a big chunk of the company if it really is a traditional kind of venture capital round. Now, if it's a note round or something else, or if it's a small seed round, that may be different. But if you're raising kind of those institutional rounds, I think that's what you could probably expect there. And really, it's going to depend on leverage and the amount that you have. The other things, you should be thinking about from day one, that overall financing strategy, and keeping that in mind. Keeping in mind kind of when you're going to need to go out and raise, keeping in mind that kind of matrix or that list of positions that you need. And to Stephen's point, the people that you need now and the people that you're going to need in the future, because you're going to need, your basically your option budget now as part of the initial kind of capitalization. And then when you go to meet with VCs, you're going to need an option budget for who you're going to need to hire to get you to that next set of milestones. So you really need to build that out, and you need to be, know that in advance of those discussions so that you go armed and you're able to kind of adequately participate in those discussions. Employment issues, non-competes and non-solicits are kind of disfavored in California right now. Other states, they are allowed. California, the case law, non-competes are generally not enforceable except in connection with the sale. And non-solicits, there's been some bad case law on those recently, but if you've got employees in other states, you want to make sure those are in place. Confidentiality and invention assignment agreements, this is critical. The business and the company has to own its IP. You cannot have a company where the founders own their IP separately, consultants own it. That will kill a financing. Make sure everybody has signed these. They've signed them on day one. The company owns the IP that it purports to own. If you don't have that and you get to that financing, you're going to have a huge issue, because you're going to have to go back to these people, and kind of beg for invention assignment agreements, confidential, agreements where you're putting IP assignment provisions in place.
And
That
Zach,
is excellent. I'm sorry. Go ahead, Sean.
yeah, I just wanted to reiterate that point, because I've seen it happen way too many times when that's not there. And so if you have a company, you have an employee handbook, just make that part of your startup package with an employee. They just sign it when that's just part of the deal when they come on board.
And also, we just have had two cases where of startups that we were mentoring, where exactly what Zach mentioned, the founder/inventor was trying to hold their IP in a separate LLC and the Delaware C Corp. And then we were just like, we're not going to introduce you to investors with that structure. And they just didn't get it. They're like, well, this happens all the time. And it's like, well, not on startups that are raising venture capital. It doesn't happen all the time. So I'm glad you brought that up, Zach. That's a great point. Did you want to add anything, Stephen, or should we go to the next slide?
You can go to the next slide.
Okay. Oh, that's the thank you slide. Well, there we go. Okay. Cool. Well, hey, Zach, thank you so much for taking us through that. That was excellent. We may go back and refer to a couple of those slides if questions come in on the cap table. And if you do have more cap table questions, please put them in the Q&A. We'll get to them. But next, we want to move on to, and also thanks to Stephen and Sean for your comments on that section. We want to move on to another massive topic that can be somewhat confusing, especially to first-time founders, which is the term sheet discussion. And Stephen's going to lead us on this. We don't have slides. We're just going to kind of talk to some points. And once again, if you have questions about term sheets, I know a lot of you are early for this. And so, but actually there's several of our startups we're helping raise Series A for right now that are going to be watching this after we wrap here. So we definitely are going to get into the nitty gritty here on term sheets, because it's extremely important that as a founder, you understand this and you work closely with your attorney. Another thing I'm going to say, of course, our esteemed panel is not going to say this, but we encounter, especially once again, with many first-time founders whose legal counsel is a friend of the family. Maybe it's your aunt who's an amazing person, but she's a divorce attorney. I will say, please, 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 please find an attorney or a law firm that works with tech startups and understands business law, because a lot of the attorneys, while they may be great attorneys in their specific area, litigators or whatever, they don't know this stuff. And so please make sure that, whether you find them on your own or you get introduced through a program like ours to someone like one of the panelists here, please do that and just do yourselves a favor. I can't tell you how many cleanup jobs we've had to have firms like Sean and Stevens and Zach's do with first-time founders who use an attorney who didn't know startups. So that's just my disclaimer there before we get into this. And Stephen, go ahead and let's get into it.
No, thank you for trying to sell everybody on our value.
No problem.
Always appreciated. You did a better job than I would have been able to do myself. So I like it. Yeah, so I mean, I'll just give a little super quick background on myself and Cooley. So like I said, I'm an attorney at Cooley here in LA. Joined the office about 7 years ago when we were about 10 attorneys, and helped scale our presence in LA to the 70 plus attorneys we are today, just here in LA. Maybe not as hockey stick growth as some of our clients, but for a law firm, it's pretty good. And so we really do focus on all things startup and tech. So everything from the venture financings to the safes and convertible notes I'll talk about today, all the way through, later stage. We're advising on M&A exits, helping through IPOs, SPACs, whatever other exits, and then kind of everything in between. So I'm sort of the general corporate attorney outside general counsel, but then we have people who specialize in IP license agreements and trademarks and kind of everything else. And so in the LA office alone, we did more than 150 venture financings last year, represent companies like Snapchat and LegalZoom and Honest Company. And those are all ones that we represented from formation. So those are really examples of our business model paying off, like identifying exciting early stage companies that we think we could really scale with and grow with, and have the capabilities to work with them all the way through big IPOs or big exits. So yeah, as Scott said, happy to just talk a little bit about about just convertible notes and safes and some considerations there. And then I was going to talk a little bit about some pitfalls to avoid in doing term sheet discussions. And so,
good call. So that's a good call.
Yeah.
We'll only do it in that order. So I'll just skip to the next one and we'll come back to that, because I think it is maybe more. It'd be better for the founders' understanding to go for this one first and then go back to term sheets. So good call. I had those out of order. So let's start with this, because this is a big one. Just so you know, we get asked this question all the time, and of course we always in every mentoring session our team does, we say we're not an attorney, please talk to your attorney, but this is what we see, kind of thing. So it'd be great to hear all of your thoughts, starting with Stephen on this, and we'll let you kind of dig into it, Stephen. And then if anyone else, Zach or Sean, has anything to add, please do.
Yeah, feel free to chime in, and attendees, feel free to answer questions. I think the more back and forth it is, the better.
Yeah.
And so here, like really early stage, your first financing probably isn't going to be a price round. It sometimes is. I mean, we represent plenty of founders that have bootstrapped their way to sometimes to huge growth rounds, or founders that are serial entrepreneurs that have sort of self-funded their way through and managed to avoid the dilution that comes from doing an earlier financing. But typical company, you're doing a safe convertible note, sometimes with a firm like Cooley or Wilson or whomever is counsel, sometimes not. And then, sometimes switching to a bigger firm later on, if you are doing it yourself or using whomever counsel at the early stage. And it's the safes and notes are great because they're easy and they're efficient, but there are still some things to think about that I think are useful to just talk through. So at a sort of threshold level, we often get the question of like, should I do a convertible note or should I do a safe? And the short answer to that is, often it's the investor who's kind of leading the way on it, and there's no wrong answer. I'll go through a couple considerations where safes are potentially a little better for companies and for founders, but we're really talking on the margins here. So I think all else being equal, if you have an investor who's ready to write a check and doesn't care either way, I'd say do a safe, but there's nothing wrong with convertible notes. They seem a little scarier, but the reality is you have a lot of investors, especially more traditional institutional ones, that are used to doing notes. And up until about 4 or 5 years ago, there were big funds everyone here has heard of that would not do safes and just weren't used to it. Times have definitely changed on that front, and people are now much more into safes as well. But some of you maybe aren't a C corporation yet and you're an LLC, like that's a scenario where doing convertible notes sometimes get a little messier. But yeah, I'd say either way, don't let the form of the instrument kill a financing round. What's much more important is getting the cash in the door quickly and being able to get back to operating. So I just took some notes on like a couple differences between the two. So one, safes are a little easier. Where safes, you have the Y Combinator form, everybody's on the same form. You literally can just pull that off the Y Combinator website, say, look, here's the changes, track changes, really just putting in dollar amounts, putting in if it's a cap, a discount, what have you. And it's easy. Where convertible notes, also we're not talking about a 50-page document, or it's not doing a Series A financing on NVCA form, but everyone has their own terms a little bit. There's some things about events of default or other kind of terms that could get a little messy. So all else being equal, safes are a little more efficient and quicker to get a deal done. Either way, so the other ones with a note, it is a debt instrument. So it's real, it's debt from an accounting perspective that goes on your book. And that does seem scary to a lot of people. It has a maturity date, it has an interest rate. Theoretically, the note holders can call a note due on maturity and try to, extract money, force company into bankruptcy, what have you. So it's a real debt instrument. That's why when you're doing notes, I would say you do need to pay attention to the maturity date, which is something that doesn't exist on a safe. So that theoretically is when the note comes due. As I'll tell you, and as other panelists will say, there's a couple of scenarios here. One is the company's a rocket ship and doing really well and just hasn't done a financing yet in which the notes convert. No investor is going to want to demand their 1x money back with a little bit of interest. The second scenario is the company is tanking and it just, for whatever reason, it didn't work out. At that point, sure, you could have a note investor demand money back. Well, if the company doesn't have money, it doesn't have money. An investor who's rational isn't going to want to just drive the company into bankruptcy. They're going to want to sort of figure something out and try to keep things around. So while it does seem scary, it's not. I've rarely had a situation where an investor actually gets paid back upon maturity or after maturity on a note, but it's something to think about. And I would try to make sure, in an ideal world, typical maturity date is probably 12 to 24 months from when the note is issued. Because the thinking is it really is a bridge financing and it's supposed to bridge you to that price round. And whether you're doing a note or a safe, you're punting on material terms till you do that price round. But that's sort of a reasonable period of time to do it. But if you're looking at it and you think, hey, look, like with where our burn rate is, and maybe you're bringing on a little larger note round, and hey, this can last 2.5 years or 3 years, like I would try to push out the maturity date at that point if you can, and just be transparent with investors on, hey, look, like this can last us a while. You still have your, if there's a cap on the note, you still have your cap locked in. We just don't want to be hamstrung and need to rush into doing a financing on terms that aren't great before the maturity. So those are sort of the main differences between the two. in terms of terms to really pay attention to, whether you're doing a note or a safe, I mean, the biggest ones, really the only two that really get heavily negotiated, we're talking about the valuation cap and then the discount. So just at a high level, what these mean, valuation cap means, let's say you take in a safe or convertible note now, you're going and you do a price round 6 months from now or a year from now, the valuation cap says, hey, in a worst case scenario, this note or safe is going to convert at the valuation cap. So what that means is, let's say the valuation cap is $5 million and you go and you raise a year from now at a $10 million valuation. That means that when you're calculating, when you're doing a pro forma and trying to figure out how these convert, new money, the new investors in the round are getting their Series Seed shares or whatever it is at the $10 million valuation, but the notes are converting at a huge discount. So at a $5 million, and sometimes that includes the available option pool, sometimes it doesn't. But putting that aside, it's essentially a 50% discount to what the investors are getting. And then the other term that goes along with it is a discount. So that means, you know, if there's a discount in a cap, then the safe or the note would convert at the better of for the investor, the discount or the cap. And so how that works is, and the whole purpose of the discount is that's the note holder saying, hey, I have the cap. The cap is kind of there. If the company just kills it, but you're killing it based on the money that you just raised, like, hey, I took a huge risk on you and I should be compensated for that risk. And so even if you raise at a 10 million, 20 million, whatever it is, you know, I'm effectively valuing the company today at $5 million. And so that should be the worst I'm converting at. What a discount does is, let's say you're not the rocket ship, or let's say for whatever reason, which happens and it's fine, you know, things take a little longer to take off. And you raise, instead of raising at a 10 million valuation, you're raising at a $5 million valuation. If an investor only has a $5 million cap, you know, they're now converting at the same terms as new money that's investing a year or 2 years after the note investment. And a lot of investors say, hey, like, that's not really the spirit of the deal. Like, that doesn't make sense. Again, that investment 2 years later is going to be less risky than my investment, and I should be compensated for that. So if you're raising at a 5 million valuation, I should have some kind of a discount still to that. And that's where the discount comes in. And so in terms of what's people always ask what's market for a cap and what's market for a discount. For a cap, I mean, the annoying legal answer is it depends, you know, especially in an insane market like we're at today. I mean, I have founders, generally serial entrepreneurs, but ones where, you know, you have an oversubscribed safe round off a concept in a board deck and their valuation cap is $15 million, even though there's not much to the company yet. And on the flip side, we see plenty where the valuation cap is more like $5 or $6 million. So it's really hard to say what's standard. I think that's a lot to do with, you know, how mature the business is, but also how much leverage you have and sort of how much the investment community feels like this is a company that's really going to scale. On the discount, you know, 10 to 20% is usually what we see, probably more like 15 to 20% when you're raising, when you don't have visibility into a financing round. It's a little different situation if you, let's say you desperately, you're close to doing that seed round, but you need 500K or you need $1 million so you could kind of scale a little more to get to that next milestone. That's where discounts sometimes would be a lot smaller, like 5 or 10%, if the investor has good visibility into you raising in the near term. But that's sort of like the general gist of it. And so to give the example again, let's say you have a safe with a valuation cap of $5 million and a 20% discount. If you do a price round at $10 million, you would say, okay, the investor would say they would get the better of the 20% discount and the 10 million and the 5 million cap, 20% discount off and we're just ignoring some of the details, but just to sort of in broad strokes do it, a 20% discount on a $10 million valuation is $8 million. $8 million is higher than the valuation, that's the valuation cap of 5. So that SAFE would convert at the $5 million valuation cap. If on the other hand, your price round is going to be at $6 million valuation, let's say, and you have a valuation cap of 5 million and a 20% discount. Now you take 20% off the 6 million, you get to 4.8 million. That's a little lower valuation, and so better for the investor than the $5 million cap. And so in that case, they convert at the 20% discount. And so these are types of things that you shouldn't, like, if there's one big takeaway on notes and SAFE, it's don't punt on thinking through this math until you do a price round later on. Like, I can't tell you how many times I have founders that have done, they did one set of notes at a 5 million cap, one at a 7, one at an 8, and it all kind of just seems like, we're bringing money in the door and these valuation caps seem sort of reasonable. But if you go and you're raising at, $8 million or whatever it is, the founder doesn't realize, oh crap, this could add up to 50+% dilution easily. And so that's where I think it's really important to, either with your legal counsel or, if you can put together a pro forma a little bit in Excel, but to sort of constantly think through as you're raising money and modeling out what it's going to look like if you're raising at $5 million, if you're raising at $20 million, and be really conservative and be realistic. Like, you don't want to be the founder that just assumes this is necessarily going to be a rocket ship and I'm going to raise at this huge valuation where this discount or the cap won't matter. Like, be realistic with yourself and really think through the different scenarios and make sure, you're comfortable with whatever the dilution is at those different scenarios. Because once you've raised, yes, you could theoretically get note holders or safe holders to renegotiate things, but unless it's a, crazy down round bad scenario for everybody where the company is going to go bankrupt if they don't do it, this is a deal you're making with them and they're going to hold you to it. And so you just really want to make sure you're thinking through it and you're comfortable with it.
Let me add something to that, because this is something that happens all the time for us, especially in our region, is that we have a founder who will watch Y Combinator demo day, and they'll see, or they'll read an article about Y Combinator demo day. They're not in Y Combinator. They're a founder down here in our region, and they'll see people coming out of Y Combinator demo day getting $16, $20 million valuations for their startups. And so they'll go out to investors thinking, well, my startup's as good as that, I should have this valuation. So I think we should also talk a little bit about what a down round is. And I think we should also talk about getting out too far ahead of yourself, because I've seen this happen where a startup has, let's say they've somehow, maybe they've brought in some, what would be called dumb money that doesn't really understand their vertical, and they've raised it a $15 million valuation. Then when they go out to the more professional investors in their vertical, and these investors see what they actually have, they go, there's no way we're going to go. There's no way you're going to raise it a $60 million valuation with our capital. And they have to do a down round, and they raise it like, say, $8 million or something. Can you talk a little bit about the dangers of overvaluing your company? Is that something you guys come across, or is that more just a thing that happens in our region occasionally?
Yeah, you do come across it, and you do come across down rounds. I would say if you're doing a price round, in ideal world, first of all, in ideal world, you have real competent legal counsel. And so when you have that comes with some real competent legal costs. And so we sort of advise, unless you have that kind of institutional investor who's really writing a meaningful check and is going to lead and wants to negotiate their own terms and board seats, et cetera, for the quote unquote dumb money and sort of friends and family, it often does make sense to do it as a note or a SAFE. And so then if, the note or SAFE is at some 16 million or whatever, and you end up raising at an 8, if there's no discount, it's just sort of tough luck to the dumb money. If there is, it dilutes the founders and you have to pay attention to it, but at least you're not in the, I think what Scott's alluding to, where there's actual price-based anti-dilution where, you've raised a seed round, priced round at a low valuation, and then all this anti-dilution kicks in for people. So I generally counsel to take that approach where, just do price rounds if it's someone putting in a meaningful size check. And if someone's putting in $1 million, $2 million plus, usually they're, some kind of institutional investor that's hopefully thought through things a little bit. And then the other thing that it's sort of the countervailing point to that is, it's everything a little bit is dumb money when it comes to how to value companies, for better or worse, especially like at the early stage, when someone says, hey, how is my startup going to be valued? The reality is even institutional investors like Upfront, Graycroft, Crosscut, whomever, just to name some in LA, they often sort of back into valuations based on how much money you're raising, where they say, hey, look, if I'm investing in a seed stage company or even a Series A stage company, I'm making this investment for the 10x plus, rocket ship kind of return. They're not making it to engineer their 2x, 3x kind of investment. And so they want a meaningful ownership chunk. And so they'll say, often it's, your each round you should think of as diluting you, or the new money getting, call it 20% of the financing round. So in that case, counterintuitively, I sort of say, you know what, the higher value, the more you raise often implies a higher valuation. So if you're raising $3 million, and so a lot of people say, well, I don't want to raise a lot because I don't want too much dilution at the early stage. And I think with notes and safes and that kind of stuff, it totally makes sense, because a note investor is, whatever their cap is their cap. They don't care how much you're raising in total. But when it comes to the price round, it often is if you're just raising $1 million, that could imply a valuation of 4, 5, 6 million. If you're raising 4 million, that's implying a valuation of more like 15 to 20 million. And part of it is this dumb venture math that people call it, where they just back into, hey, I want to own 20% of the company. But part of it is you are de-risking their investment the more you're raising. Like a company has more to work with, more ability to pivot and to try different things if you're raising, and really scale if you're raising 4 million versus 1 million. So maybe panelists will disagree, but I generally don't counsel companies to worry too much of, hey, am I raising it too high of a valuation? Definitely not with the notes and safe, a little bit more with the price round, but it's more, sometimes raising more is better, rather than raising less if you have the option, because it could drive up the valuation.
So we've got a couple questions from the founders. Ed asks, is a warrant the same as a safe or another type of debt instrument?
So a warrant is kind of totally different. I think you should think of a warrant as more of an equity instrument. It's sort of more of an option. It's essentially the same as an option grant, but for a bunch of reasons. One being you don't have to be you have to be a service provider, and there's a bunch of regulations. Like often you can't issue to entities under an option plan. So there's a lot of regulations and rules and things you need to think about from securities law exemptions if you're issuing options that don't often apply to warrants. But you should think of it as the same as an option. It has an exercise price. They're getting some amount of shares, and they have to pay at exercise. You can net exercise. It gets a little more complicated. It's basically a complicated options instrument, but it's not indebtedness, but it does sometimes come along with indebtedness, where you have, a venture debt. The Silicon Valley Bank for sure, always wants some amounts of warrants, which is really kind of equity upside sweetener, whatever you want to call it, that goes along with debt, but it's not debt itself.
Sean or Zach, do you want to add anything to that, or does that cover it?
I think that I think that pretty much covers it. And just to reiterate Stephen's point, I mean, the banks will absolutely ask for that as part of any debt facility. But I think he pretty much covered it really well.
Okay, cool. Chris asked, is it a red flag if a potential investor will only do convertible notes and will not consider safes?
So I say no. I mean, maybe other panelists disagree. The reality is, institutional investors at this point will usually do both, but you have institutional investors that are more debt focused who they want a debt instrument because that's what they're used to. And when it comes to angels and friends and family, I mean, you have people that are just used to doing notes because that's literally all that existed until, even though, if Y Combinator does something, it's suddenly, the cool thing to do and market, and now everyone's doing safe. Like it's not ancient history where they did not exist. And so to me, it's just investor preference. It's fair to try to push them to safe and say, hey, so-and-so and so-and-so is also in on the safe round. It would just be easier, but I wouldn't see it as necessarily a red flag.
Yeah, I just add that I think some investors, that's their protocol. That's what they do. I think it's also good to look at who the investor is and what type of relationships they may have. So it could be an investor that all they do is convertible notes, but they may be a great investor for the company because of other relations they have within the industry that you're in.
It's a good point. Zach?
Yeah, I think that's absolutely right. And I think the most important thing, I mean, there's some investors that do have the preference towards convertible notes, but the most important thing is getting the money in, get the money in, help the company grow and scale, and hopefully get to that bigger financing.
Yeah.
Yeah,
Go ahead.
Oh, yeah, I agree. And the only thing I would add to my earlier point is you do just be a little more careful if it's a convertible note. Like if you have a note investor and they say, hey, I want a 3-month maturity and a 12% interest rate, and they seem like they're someone that is really just looking for a quick return, or you don't have a good relationship with, or could potentially tank the business, that is a red flag. Someone that just is fine with short, small interest rate, 24-month kind of maturity, you have a good relationship with, I wouldn't care. But you just want to make sure they're not doing. There's certain investors that don't realize, and the companies get in trouble where these investors don't really realize, like, hey, I'm making a very risky venture investment and I'm not doing it for cash in a year. I'm doing it because I hope that this 10X, 100X, whatever. And so you want to sort of suss that out a little bit. If it seems like you have someone who really sees themselves as a debt investor, that's going to make your life really difficult.
Look, I mean, the reality for us, especially if you're not in one of the hot startup areas, if you're not in the Bay Area, the reality is that despite founders not wanting to hear this from me, I mean, we work on a lot of these deals to try to help startups raise capital. We just closed 6 in the last 6 months, which isn't a lot for the coast, but for out here, it's a big deal. And I will say the first thing is, at the end of the day, you're gonna have to take what you can get as a startup. If you think you're if you are acting as though you're a Y Combinator grad and you're not, and you go out with a post-money safe and you don't get any investor meetings or any traction, then you may have to consider a convertible note. Or if you're not getting any investors interested in a convertible note and they're investors that will only do price rounds, you may have to do a price round. So I would say that it depends on how much you need the money to grow your startup. And if you need the money at a certain point, you may have to do a deal, not that puts your company in jeopardy, but that is not the ideal Bay Area awesome deal that you hear or read about in TechCrunch or whatever. So just, be aware of that. Also,
just a real quick point. I just wanted to reiterate what Stephen said, because I think it's an important point, is that if someone that is offering a convertible note and they're very concerned about a higher interest rate, I'd be very concerned about that when looking at that, because that doesn't, and the convertible note is geared towards converting into equity, and they should be more concerned about that than getting interest off the convertible note.
That's a great point. Ed is asking a question. I'm sorry, Ed. I'm also, some of your questions are, I understand, some I'm not, but you ask, and does the panel have recommendations on debt equity ratios for their startup clients? So I'm not really sure. I think there may be a little bit of misunderstanding there, but 50-50 or something else, Ed asks. I think that maybe you're asking a different question about just debt instruments outside of raising equity capital. I'm not really clear. Maybe you can clarify. And this one of the panelists understands that. I just might be missing it. But let's come back to that one unless one of the panelists wants to answer that. Anand asks, can you do a crowdfunding campaign at the same time you do a separate round for VCs with different instruments and valuations? That's a great question. And when he says crowdfunding, of course, he means equity crowdfunding, not Kickstarter. So like a Republic.co, a WeFunder, or whatever, that's what he's talking about.
So, I mean, I guess the short answer is possibly. I would say, particularly if you're doing anything crowdfunding, you really need competent counsel. They could go horribly wrong, and can probably the easiest way to make yourself not investable is to do some crowdfunding campaign in a way where you haven't kind of thought through things and haven't used real counsel, and now you have, you know, literally hundreds of people on your cap table, and it's just a total mess, no securities laws exemptions, you know, not done appropriately. So that's easy. I mean, you need to raise money how you can, and so I don't fault anyone for doing that. But I mean, I would raise on a safe or convertible note from an institution, from a, you know, accredited investor 100 times out of 100 before I would do crowdfunding. But clients do, and not to say no client of ours does it, you know, they do it and some do it very successfully. You just need to be really careful about it. And doing it at the same time is not something that we usually see. I mean, doing any kind of 2 financing rounds at one time isn't something you usually see, because it just opens you up to a lot of disclosure requirements, a lot of sort of potential fraud claims, you know, misrepresentation kind of claims. If you have a crowd, if you're raising from institutional investors at a $12 million valuation and from the public or from a crowdfunder at a 20 million valuation, like that, to me, there's material risk unless you've made it really, really clear to everyone involved, you know, what you're doing. So anytime you're doing 2 at one time or a crowdfunding kind of thing, you just need to be extra careful, is my advice.
And we've helped 6 startups do crowdfunding campaigns with our mentoring team. And I'll just add that similar to back in the day, a few years ago with Indiegogo and Kickstarter, you know, obviously it's great if you completely crush your equity crowdfunding. And now that they've changed the rules, it was a max of 1.7 million. Now it can go up to, I believe, 5 in your first outing. But in any case, we have startups that have maxed out their 1,070,000, and then that's help them raise money from not only prominent angels but also some VCs. So it can work, but it can also backfire. So similar to if you do a Kickstarter campaign that's public and your goal is to raise $500,000 and you raise 50, then that's not really such a great signal to folks in general if you're doing non-equity like Kickstarter. And if you're doing an equity round like with Republic or another platform, and like, again, let's say your goal is to raise 1,070,000 and you raise 120,000, that is not a great signal. And also another thing to know about a lot of these platforms, because we work with them and they're, you know, the platforms are great in themselves, but a lot of times they don't really help you that much as a founder until you get to a certain amount of money that you've raised. And we have another, I'll get anyone who's interested. We have an entire discussion panel we did a couple of weeks ago for this Riverside Angel Summit on equity crowdfunding and alternative funding mechanisms. So if you can ping us and we can get you that link. But I just want to throw that out there because a lot of people think, oh, I'm having trouble raising from angels and VCs. I've gotten emails and calls from 3 or 4 equity crowdfunding platforms. I'll just do that. And it's not, and as Stephen said, it's not always the best decision, just so we all know.
Yeah, and I think Stephen makes a great point that you know, I think your $1,000 shareholder that invests $1,000 from a practical perspective can be much more of a pain than someone that invests $1 million.
Yeah, and also just so the founders know, the good equity crowdfunding platforms will do basically an SPV for you so you won't have all those investors on your cap table. You'll just have one line in the cap table. But not all of them do that. So that's a good thing. So again, just like with anything else, do your diligence on the equity crowdfunding platform partner, just like you would on any other investor, and see if, you know, they're well recommended and what they're proposing is fair. And if you don't understand it or don't get it, talk to your attorney or us. Our mentor team knows a lot about it, as I said. But let's move on. Ed has a good question. Back to cap tables. Does the panel have any recommendations on debt equity ratio? Oh, wait, sorry. That's the one I already asked, and I wasn't sure if we knew the answer. This is from Mark, sorry. Any standard Excel-based cap table format available or recommended to use? Before the panel answers, we also have a series on that, and we shared some examples on how to build your fundraising strategy. So again, I'll let the panel answer, but we also have an entire series on that as well for you to go check out at some point. So any thoughts on that, panel? Like, you know,
I'm happy to take it. I mean, I don't think there's any specific Excel, file that you should start from. I'm sure all of them, especially early on, are probably, very able to create a cap table for an early stage startup company. So I'd probably just encourage you to go to the series that they've done and just take a look at the example from whatever Excel file they use there, and that's probably sufficient.
Yeah, and there's also vendors, of course, who are doing it to try to make it easier for founders. And so there's like Founders Suite and others, and we link to all those. But again, as a startup that hasn't raised any capital, I would spend as little money as possible on all these SaaS providers that are trying to help you, because it's easy for a startup to suddenly be, paying out a few $100 a month to a bunch of different SaaS things to try to help them when they actually haven't raised any capital. And I would keep it as simple as possible. So to Zach's point, I think an Excel spreadsheet as you're starting out is probably the best way to go, and it's free. And yeah, we have templates. Techstars has a great template that we often recommend, but in any case, there are a number of free templates out there you can grab from the internet. So that we'll get you that info. Okay, cool. So maybe we should go back and talk a little bit about, unless are there more founder questions about safes, notes, or price rounds? Let's go back and talk a little bit about term sheets if we can, if that's okay with the panel. Stephen, can we talk a little bit about term sheets and a couple of things, a couple of gotchas, a couple of things to watch out for as a founder when you do get that term sheet for your priced round from a VC?
Sure. Yeah. And I know everyone here is at different stages. And so, but I just sort of thought through here a couple like mistakes to avoid or big things to pay attention to at a high level. I mean, you could spend hours kind of going through all the details and intricacies of term sheets. Definitely engage. I mean, I guess before I get into the biggest mistake companies make is come to Cooley or whoever when they have a signed term sheet and say, hey, here's the signed term sheet. Can you help with the deal? I mean, yes, the term sheet is technically non-binding, but do not take that to mean investors are going to be completely fine with you, renegotiating material terms in it. Like that really isn't how it works. And there's often things like exclusivity built into the term sheet where you're a little bit stuck. So where you as a founder have the most leverage is when you have a term sheet and you haven't signed a term sheet. Because when you have a term sheet, by definition, basically that means you have an investor who wants to invest in you, who's excited to invest in you. They don't know how competitive the process is. Hopefully you've convinced them, or they think, there are other people in play, and they want the deal. And so that's where, they're going to be willing to make concessions. They're going to be willing to negotiate on some terms. Once you have a signed term sheet, you're now saying, I'm going with you. Now they have the leverage. And so things that aren't in the term sheet, things that are investor favorable in the term sheet that you don't like, it becomes a lot harder to renegotiate after the fact. And so I'm like, you know what? If anything, have me look at the term sheet and then not even look at the definitive documents. You should think of the term sheet as the most important part of the whole deal. And so on that note, here are just a couple of things to really kind of hone in on and think about. So one is board composition. So aside from valuation, the single most important thing to your company is who controls the board. Like I have so many founders that are fixated on like, well, Mark Zuckerberg has 10-to-1 voting shares, or Evan Spiegel negotiated this with Snapchat. And that's great. You know, maybe they had the most leverage in the world. Maybe they negotiated that stuff down the line. But the reality is it doesn't even matter. It doesn't matter if you have 10-to-1 voting shares and an investor controls the board. You know, most decisions of the company are made at the board level. There are certain things under Delaware law. There are certain things that investors will negotiate in the certificate of incorporation that require shareholder votes. But by and large, it's board decisions. Whether you're going to make an option grant to someone, how much, whether you're going to hire a CTO, whether you're going to enter into some huge, you know, commercial agreement, all of that sort of stuff is at the board level. And so I mean, I had actually it was a Techstars seed stage company that was really excited with the term sheet, said, hey, investor is going to partner with us. We're really collaborative. In the board composition of the term sheet had founder getting 1 seat, investor getting 1 seat, and then 1 seat for an independent. And so that sounds reasonable and good because the investor is saying, hey, look, we're partnering it together. It's me and you. Investor only owns 20% of the company. Valuation's good. Founder was really excited, signed the term sheet. One of those where then they said, hey, here's the term sheet. But without realizing it, what the founder did was just basically give up control of her entire company, because now you have a board where it's the founder and the investor. There's literally nothing material outside the ordinary course of business that the founder can now do without getting the investor sign off. And the founder was just focused on valuation's good, investor only controlled 20% of the company, and just didn't really pay attention to the board composition. And then without realizing it, gave up control. And even more so, if the founder then decided, okay, here's a good independent, we'll put an independent in that seat. Now it's 1 founder, 1 investor, and 1 independent. If the investor and independent wake up one morning and they just decide, you know what, I don't really like the founder anymore, they can fire the founder as CEO. Maybe that implicates founder vesting, maybe it doesn't, but literally the founder's just been fired from her own company without really realizing it was even an option. So that I think is the outside from valuation, the most important point. And to me, I mean, board composition, it's a little bit to do with leverage, but you know, all else being equal, it really should reflect ownership. So if an investor owns 25% of the company, doesn't really make, or 20% of the company, doesn't make sense the investor gets 1 of 3 board seats. It should be 1 of 4 or 1 of 5. The founder who still maybe, or founders who own 50, 60, whatever percent of the company, you know, that means they should have a majority of the board. And so at a seed stage, that would mean pushing for something like 2 founder seats and 1 investor seat, maybe 3, you know, founder, company, common CEO seats, however, you know, the details are worked out, in 1 investor seat, but definitely not a quote unquote balanced board where common has as many board seats as the new preferred investors. So the second point would be, it's sort of economics, but on valuation, don't just look at the top line valuation. It's very tempting to say, oh, hey, I wanted to raise at a $10 million valuation. Investor gave me a term sheet at $10 million valuation. That means everything is great. Like really model out the pro forma and see what this will actually look like based on that valuation. For instance, usually in term sheets, an investor will put in something saying, hey, the valuation will include an available option pool that will be on the pre-money, so that won't dilute the investor of a certain percentage. So in that valuation, let's say it's a $10 million valuation, but let's say one investor wants an option pool of 20% and the other one wants an option pool of 10%. You as a founder might think, oh, well, bigger option pool is better. You know, I want to hire more people. This all sounds well and good. But the whole reason investor wants that big option pool is because it just dilutes you and existing stockholders and it doesn't dilute the investor. So with a $10 million example and a 20% pool, that really means all existing shareholders' stock is valued at $8 million. The option pool is valued at $2 million. And let's say you raise $2 million. So new money is $2 million above that. So you now as existing stockholders own 8 million of the 12 million, which is 67%, versus if it's a 10% pool, that means you really own 9%, 9 million worth of shares. The option pool is 1 million worth of shares of that 10, with a $12 million post with 2 million in new money. You now own 9 million of the 12. So you own 75% of the company. So paying attention to the option pool is massively important. Also, like if you have convertible notes in safe, investors usually want them all to convert on the pre-money. That is standard and typical. But maybe you have a lot of leverage and maybe you could negotiate that. And so putting notes in safe, having those dilute the new money as well, is massively beneficial to you. So I would just, there's a lot of complexity and a lot you could kind of get into, but big takeaway is really pay attention to the option pool size, really pay attention to whether the note, they specify the notes are converting on the pre-money or post, and model this stuff out so you really see what you're getting yourself into. And so, holistically, you can look at things. And if you do it and you realize, wow, crap, with a 15% pool, this is really rough, maybe you could negotiate a lower pool. And to do that, it's kind of often most effective to tell the investor, hey, look, like investors want to know you're not going to need to increase the size of the pool before the next financing. That's sort of their goal. And so if you model to the investor and you say, hey, look, here's all the hires I'm anticipating over the next 12 to 18 months. And if that adds up to 6 or 7% or whatever it is, you often can negotiate the pool down a little bit if it's credible. That's just something to really pay attention to, that, some people think of it as a quote unquote legal point, but it's not. I mean, it's just pure business, pure valuation, that just drives your ownership.
So I think the main takeaway here, and I also, I know that a lot of the startups that are on the webinar live here aren't at the point to be getting term sheets because they're very early in their journey. But I've already said this earlier, but it's absolutely critical at this stage that you have an attorney who knows what he or she is doing. Term sheets can be extremely confusing, and obviously just with a few things that Stephen has just talked about, and that's just the tip of the iceberg of things that could be in as gotchas to a first-time founder. So again, 100% recommend that if you don't already have a startup attorney, you definitely need to have one by the time you're at the term sheet discussion. And as Stephen said, please don't wait until you have a term sheet that you've already signed or you're about to sign and expect one of our amazing panelists to drop everything they're doing and help you do some type of emergency review. I mean, these folks are all extremely busy. So just, let's, take the term sheet thing seriously. Make sure you already have your relationship with your startup attorney built before you get to that stage would be my advice. And Zach and Sean, did you want to add anything to some of the term sheet gotchas that you've seen for founders while we're on the topic? And also if any of the startups have any questions, Ed, we'll get to your question in just a sec, but I want to finish on this term sheet thing first.
Yeah, no, absolutely. So yeah, just to reiterate your point, it's very, very hard to come in late in the game if you've had a founder already negotiate the term sheet, and then you give it to your attorney to do a final review. You have no leverage to renegotiate the deal at that point. You just have none, because you've had the founder kind of give away everything along the way, and it's really, really hard to claw those things back. And to Stephen's point earlier, once you've signed that, they are going to hit you over the head with it 100 times and say, you've signed it, you've already agreed to it. We're not renegotiating, we're not retrading the deal. So really, really important to bring people in early on in the process as well, just to kind of clean everything up, make sure everything looks right. and that you're kind of negotiating along the way. Other things that sometimes come up, there are particular blocking rights and things to keep in mind. There's a whole suite of blocks that are typical that are negotiated as part of this, as part of a preferred stock financing. And I think you want to pay particular attention there, because there is the kind of affirmative board control that Stephen went through as part of his presentation. And then there's kind of negative control, things that you can't do without getting their consent. Very, very important to try to keep those as limited as possible to the extent that you can and within reason. And then other things that can just be kind of gotchas or problematic later on, redemption kind of on a short fuse, where the investors have the ability to get their money back on a very, very short timetable. That is a very, very bad term, very, very bad sign to see something like that in there. So just another kind of thing to just keep an eye out for. But I'm sure Sean has other gotchas, and I'll turn it over to him.
Yeah, I think the one point that I've found that founders don't really understand is the difference between participating and non-participating shares, and you really need to understand that that's in some of the vernacular that's used in these. It's important to have an attorney look at. It's a difference between, in a participating preferred share, that person takes their money off the top and then they participate again in the percentage of their interest in the company. So if that's the term that you agree to, then fine, but you need to understand it.
Yeah, no, I agree with all that. They're making my job easy, ticking off some other things I was going to go through. But yeah, I mean, you could spend a bunch of time, but I think at a high level that makes sense. The last thing I would just, that sort of ties back into Zach's presentation, is just founder vesting. The term sheet stage is often where this comes up, and if an investor doesn't put it in the term sheet, it's sometimes a good idea to still see if, just to reiterate, make sure they've seen your stock purchase agreements, reiterate, this is what it is, because it is often something that investor is going to push for. And sometimes investor doesn't hire their own deal counsel on the term sheets, and then they hire, Cooley or whomever, and then we say, hey, founders are basically fully vested. What do you want to do there? And then they go back and say, okay, well, yeah, I didn't raise this at a term sheet stage, but I want you to be 25% vested at closing or whatever it is. And it becomes a huge sticking point, especially if maybe you have 3 founders and one founder doesn't really want to agree to it. And so the more you could kind of have that conversation early on when you have leverage, which is before a term sheet sign, the better, because at the seed stage, that's something that often comes up.
Cool. Any other questions from the founders on term sheets? And again, I know, sorry, I'm having my mouse is freaking out on my screen here and shutting windows down. Any other thoughts that we want to cover? Any other questions? Let's answer Ed's question while we're all here. To clarify, perhaps, if you cannot raise the desired amount of capital as 100% equity financing, what do you recommend for the debt versus equity ratio? Does anyone want to take that? That might be more of a CFO question, but if you guys want to take that, that would be fine.
Well, so, I mean, one thing is, I guess it depends who you're getting the debt from and what the debt is looking like. I mean, often in connection with a financing round, companies will do venture debt from something like Silicon Valley Bank or Square One. In that one, they sort of make the decision for you, where they're going to just set their maximum as a percentage often of how much you raise. So you're not going to raise $10 million and then do a $10 million credit facility usually with them. It'll be more of like, call it 2 to 4 or 2 to 5 kind of thing. So it's often sort of decided for you when you're doing that. Usually if you're talking about like true debt where some third party is going to have debt with an interest rate, I mean, price equity investors are going to have blocking rights often over that stuff, and they're not going to like it often. Where if you're an equity investor, you want money going to grow the business, you want to make sure the round is big enough to where it can support the business. Like it is a tough sell a little bit if you're going to say, hey, I'm raising 2, and then I have 2 two more in debt, and that debt has like a 8% interest rate or something, and it's going to need to get paid back. Now as an equity investor, you're just introducing a lot more risk to your investment, and there's a lot of money out the door in terms of interest payments. When the company, the equity investor wants you to be that 10x, 100x kind of company, not worrying about how do I get from step 1 to step 1.3 so I could pay back debt. So it often, not always, but it often is a little bit binary, where either you have companies that are kind of venture backed, where you've been able to convince investors that you have a big addressable market or great, whatever it is, where you're going for that huge exit, or it's a company that maybe is even better, but it's more of like a sustainable, lower growth kind of thing, but still could be an amazing company. It could still sell for 9 figures plus, but then you're kind of looking at debt, and it's more, maybe it's sort of a factoring agreement, or maybe you need it for and we have a lot of like B2C companies and e-commerce companies that need a kind of debt facility for goods, basically just for cost. So it depends, but you don't often see a kind of, I'm raising equity and I'm raising true debt that's not venture debt right alongside it.
Okay, cool. So before we wrap, if there are any other questions from the founders, please put them in the Q&A and we'll get to them. It doesn't look like, if there are not any more questions, then we can, there we go. Ed says, thanks. So I guess we answered his question. Yeah, I think I also, for those of you that are watching this live, I put in the chat 3 different other workshops we had that you may find interesting. One is goes into a deep dive on how to design your investment strategy and tools to use, and we go through some examples, some real-time examples. I show one of our lists that we created, that I created for one of the startups. But anyway, and then the alternative funding one is talking more about things that Stephen was just talking a little bit about, whether that's early stage, trying to get an SBA loan, or that's equity crowdfunding or other types of funding outside of angel and VC equity capital raises. You might check that out if you don't feel like you're quite ready or at a stage where you can legitimately raise equity capital. And then if you want to hear from investors themselves, we had a panel last week called How Investors Make Buying Decisions. And that was an excellent panel for you to get a sense. We had both deep tech, because in our region, we have a combination of a lot of deep tech startups, which are verticals like ag tech and clean tech and biotech. And then we also have B2B SaaS and logistics. So we have a kind of an interesting mix of verticals that our founders are playing in out here. And we had VCs from both that are both deep tech VCs and B2B and B2C VCs. So you might want to check that out and just see what they say. We actually went through some specific examples of the kind of traction that they're looking for before they'll even want to take a meeting with you. So I know that a lot of the founders get tired of hearing from me that you're not ready to raise capital. So you might check that link out and hear it from some other investors. And as I said in that, on that topic, when I tell you that you're not ready to raise capital, that's just my opinion, but it also comes from having worked on, helped hundreds of startups raise capital, and also been a former founder of 5, co-founder or founder of 5 startups myself. So I do have some experience in raising capital. And I recommend you check some of that out, because again, and the same thing's going to happen with the attorneys. If you get Zach or Steven or Sean on board as your attorney, and you're not ready to raise capital, the way the raising capital works is it's a relationship business. So, we're not going to unfortunately be able to introduce you to our investor network if you are not ready to raise capital, because if we do that, then those investors stop taking our calls and our emails. So that's just the way that the game works. And if you, again, if you need to understand where you need to be for your type of vertical in terms of traction before you can really go out and get interest and excitement from institutional investors at the seed stage or the Series A stage, please get in touch with us, because we can help you with that. And so can any of the law firms and attorneys on this workshop. So with that, if there are no more questions, let's wrap it up. Let's thank our panelists. We really appreciate you all taking the time to come and educate us on these topics. We get these questions literally weekly, on a weekly basis, from the startups that we mentor in our program at UC Riverside. And so we appreciate you taking the time. So Sean, thank you. Stephen, thank you. And Zach, thank you. Martin, anything else you want to, oh, I guess we didn't put the Riverside Angel Summit URL in there, but it's pretty easy. And I guess you won't see the chat if you're seeing this after the fact, which many of the founders are. So it's riversideangelsummit.com if you have any questions about that in terms of raising capital for your startup if you're in this region. And any other words of wisdom from the panel, or should we wrap it up?
Well, I just wanted to say thank you to all three of our panelists. It was extremely helpful, very, very educational. And yeah, it'd be worth revisiting once we get this recorded, Scott, for all of us to come back again. That was a lot of information.
Yeah, definitely.
Today or early this week, Scott, we're going to be making a determination who becomes the quarterfinalists.
That's right.
And then also in about a week or so, our last workshop pertaining to the principles of due diligence will be happening as well. So I would encourage everybody to join us for that as well. And that information is all on our website. Okay,
cool. And if you are a startup that needs any kind of mentoring help, this is our program. It's called Epic Small Business Development Center. We do this for the community and for the region at no cost to the startup. We don't take any equity. We don't charge any consulting fees. We're grant funded and supported by UC Riverside and the SBA at Washington, as well as the governor's office, GoBiz, as well as some of the cities and counties in the region, and also some corporations. So we appreciate all their support so that we can deliver this help to the startups at no cost to them and help them scale and grow. So thanks everyone for joining, and we will see you soon. So everyone take care.